Hello, I'm Jack Kelly, Fixed Income Portfolio Management at Fineco Asset Management. Today I'll talk about our active fixed income fund offering, with focus on the following funds: the FAM Euro Aggregate Bond Fund and the FAM Euro Inflation Linked Government Bond Fund. The market environment in fixed income has been volatile. We're moving from a regime of central bank dominance, suppressed yields, into a healthier, reflated bond market. This 2023 post-QE regime for fixed income is exhibiting more of the classic bond characteristics. Those are 1. A welcome sensitivity to fundamental economic data, 2. A healthy dispersion of performance by country, 3. Safe haven characteristics, and 4. A running yield which offers a good comparison to other asset classes. Inflation has been the trigger for this change in regime. It has forced central banks to move away from quantitative easing. Active management has become more in vogue again, as we can use our toolkit to identify value in bond markets in areas of duration, curve, and cross-market opportunities. When we construct bond portfolios, we search for strategic opportunities to add value and guard against downside risks. For example, both funds have taken strategies in overweight inflation-linked bonds, what we call break-even trades. The view is that inflation risks will remain elevated for some time. The bond markets themselves have already priced a view of the immaculate disinflation. This is the idea that inflation will move back to the old normal of the last 10 years of 2 to 2.5%. We think this is too sanguine a view. Key changes in the reversal of globalization and tighter labor markets will likely keep inflation volatile. Shifts towards a sustainable energy policy, while long-term positive, will be inflationary in the shorter term. At the same time, governments only issue a small fraction of total issuance in inflation-linked bonds, meaning continued scarcity in these bonds as demand for inflation protection increases. We use an active overlay approach to position portfolios and seek opportunities in global bonds to add value. For example, over last year, we could see that Japan's policy of yield curve control, introduced originally to help generate inflation, was simply the wrong policy setting in an environment of higher global yields and rising prices. We also believe that the Bank of Japan policy was unsustainable, as it was leading the yen to weaken too quickly. On both funds, we moved underweight the Japanese bond market to capture the likely abandonment of YCC and add value on the funds. Using a disciplined approach to bond strategy, assessing each sovereign market individually on its valuation, economic cycle, and regulatory environment. Applying a clear, transparent framework for discussion allows us to target opportunities where and when they occur. We expect, with yields now more elevated, that 2023 should be a positive environment for fixed income. Euro aggregate and inflation-linked bonds should benefit from a shift in the cycle and the relatively attractive yields and risk-adjusted returns compared to other asset classes. The active approach we take should help enhance performance and guard against obvious pitfalls as we move through the year. Thank you for listening, and see you in the next video.